Welcome to the deep dive you need right now. We are Talk Tickers, your shortcut to being well-informed, and today we are breaking down the Q2 2025 earnings call for Firefly Aerospace, ticker FLY.
Yeah, this was a big one. Their first report since the IPO. A lot of anticipation.
Definitely. And, well, the market reaction told a story, a pretty brutal story, actually.
Absolutely brutal. It felt like a major reality check. The stock just cratered right after the numbers came out. So today we're going to try and sort through that, the immediate pain versus the longer-term picture management kept pointing towards.
Okay, let's dive in. Start with those headline numbers that really caused the sell-off. They were not great.
Not great is putting it mildly. The big one was the loss per share. GAAP EPS came in at a loss of $5.78.
$5.78. Wow.
Yeah, and compare that to what the street was expecting on a non-GAAP basis, which was like a loss of only $0.44. Huge disconnect.
Okay, hold on. GAAP, non-GAAP. Can you quickly break that down? Why the massive difference, and why does the market usually look at non-GAAP?
Sure. So GAAP is the official accounting standard, right? All the rules. Non-GAAP pulls out certain items, maybe one-offs, non-cash stuff like stock compensation or, significant costs tied to something specific like the IPO itself, maybe warrant expenses.
Got it.
And analysts often focus on non-GAAP because it's supposed to show the sort of underlying operational performance. But here, well, that GAAP loss, the actual bottom line, was just so much worse than expected. Couldn't really ignore it.
And the revenue didn't exactly help matters either.
No, definitely not. Revenue was $15.55 million. The consensus range was, maybe $16.8 million on the low end? So a miss there, too. And that's down 26.2% compared to the same quarter last year.
Oof. So loss way bigger than expected, revenue down significantly year over year, and a miss. What was the explanation?
Well, management pointed directly at the Alpha rocket mishap back in April. For these launch companies, revenue recognition is often tied to successful launches. You have a failure, things grind to a halt.
So the cadence gets delayed.
Exactly. The whole mission schedule slips, and the revenue you expected to book just gets pushed out. So one technical issue basically tanks the quarter's P&L, the profit and loss.
Right. So their argument is, look, it was a specific event, not a fundamental problem. But was there anything positive in the financials? Any silver lining?
There was one bit, yeah, though it got a bit buried. Gross profit actually went up year over year, came in at $4.0 million versus $3.0 million last year.
Okay, so gross profit improved. How does that square with revenue falling so much?
Good question. It translates to a 25.7% gross margin, which looks pretty healthy. But management clarified this wasn't really from launch activities.
Oh. So where did it come from?
It was mainly driven by a contract modification, specifically for the Blue Ghost mission to lunar lander.
Interesting. So more like higher margin services work, payload integration, that kind of thing.
Precisely. It signaled they're potentially shifting towards services, which can be more profitable and less volatile than just launching rockets. If they scale that side, that margin improvement could be a really positive sign for the future business model.
That makes sense. Okay, but the P&L was rough. The real buffer against these kinds of operational hits has to be the balance sheet, right? Especially post-IPO. Let's talk cash.
Yeah, that's their key strength right now. They raised $1 billion gross in the IPO back in August.
$1 billion?
Yep. They paid off about $148 million in debt, a term loan. So as of late August, they were sitting on roughly $1 billion in cash, equivalents, and restricted cash. Plus, they've got a new $125 million revolving credit line available.
So they have breathing room, a lot of it.
Definitely. Enough runway to handle losses for quite a while as they build things out.
Okay, so the cash provides stability. But the market's clearly worried about the near-term profitability. So management's counter-argument must be the pipeline, the future business. What's the backlog look like?
It's strong. Total backlog was about $1.3 billion at the end of July.
$1.3 billion. That sounds substantial, especially compared to some other players struggling for contracts. But how much of that is like near-term real revenue versus long-term promises?
That's the key question, isn't it? And the market's definitely skeptical. A big chunk of that $1.3 billion came from a single award in July, the Blue Ghost Mission 4, or BGM-4.
How much was that one worth?
$176.7 million. It's for delivering NASA payloads to the moon's south pole. Huge win, shows confidence.
But when is that mission actually scheduled?
Not until 2029.
So great for the long-term story, but doesn't help Q3 or Q4 revenue this year.
Exactly. Still, management stuck to their full-year guidance for fiscal 25. They're forecasting $133 million to $145 million in revenue.
So they believe they can convert other existing contracts quickly.
That's the signal, yes. If, and it's a big if, they can get Alpha launching reliably again, like right now.
Which brings us perfectly to the operational side. That April Alpha mishap caused the Q2 pain. What's the status on getting Alpha back to flight?
Good news there. The FAA gave them the green light, their return-to-flight approval, on August 26th.
Okay. And what did they actually have to fix? Was it major?
Management described the fixes as relatively minor but critical. They beefed up the thermal protection on the first stage. Apparently, it burned through too early. And they're also tweaking the flight plan to reduce the angle of attack during the highest stress parts of ascent.
Reducing angle of attack. Does that limit the kinds of orbits they can reach? Maybe for military missions.
They said no, not really. It's managed within the flight profile, shouldn't materially impact mission capability. It's mainly about making that first stage more robust during maximum aerodynamic pressure.
Got it. So the pressure is all on the next launch, Flight 7, they said in the coming weeks.
Yep, coming weeks. They plan 2 more Alpha launches this calendar year, including that crucial Flight 7, and they mentioned they're already building hardware ahead for 2026 to ramp up the cadence.
Building ahead burned cash faster, though. Bit of a gamble if Flight 7 slips again.
It is. But it shows confidence, maybe trying to capture a market share. If it works, great. They also highlighted some key Alpha programs, that $22 million Victus-Sol responsive launch contract, for one.
Right.
And a new Air Force Research Lab contract to develop a ceramic rocket engine nozzle.
Ceramic. Why is that a big deal?
Weight saving. Mass reduction, they think they can cut the nozzle weight by potentially up to 50% compared to metal ones.
And less weight on the rocket means?
More payload capacity or better performance. Improves the economics, makes Alpha more competitive, shows they're still innovating, not just fixing problems.
Okay, so Alpha's the immediate focus. What about diversification? Let's talk Blue Ghost, the lunar program.
Lunar's looking really promising and potentially high margin. They got a $10 million add-on from NASA this quarter just for data from the first Blue Ghost mission.
So selling the data itself is becoming a revenue stream.
Looks like it. A high margin, maybe recurring one. And they're leveraging those NASA missions too. Blue Ghost Mission 2 is taking the UAE's Rashid 2 rover to the moon.
Ah, so they use the main NASA contract to cover the core costs, then sell extra capacity to international or commercial customers.
That's the model. Makes those government contracts work double duty. Smart.
Okay, smart. Now, the next big thing, the medium-lift rocket, Eclipse.
Yeah.
This is their play for the bigger national security launches, right? How's the engine testing going?
Progress there seems solid. Helped by that $50 million investment from Northrop Grumman, their partner, they've done 95 hot fire tests of the Miranda engine.
Yeah, 95 tests. Any key milestones hit?
Yes. Critically, they completed tests at full power, and they achieved a 206-second mission duty cycle firing.
206 seconds. Why is that specific number important? Is that like a full first stage burn?
That's exactly it. Hitting the full duration means the engine can reliably perform for as long as needed during an actual flights. A major step, moving it closer to production. They've also fit-checked the tanks. The target for the first launch is next year.
And the goal is competing for that big national security space launch contract, NSL Lane 1.
Yeah, aiming for the late 2026 timeframe for that competition. That's the big prize.
Huge prize. Okay, one more area. Space domain awareness, defense stuff.
Right. That's using their Electra spacecraft bus. They won a contract from the DIU Defense Innovation Unit for a mission in 2027.
What's the mission?
Demonstrating rendezvous and proximity operations, or RPO.
RPO. So, like, getting close to other satellites, docking, inspection, repair, that kind of thing. Why is that so important now?
It's absolutely critical for military operations in space. Resilience, monitoring potential servicing, mastering RPO opens the door to huge future programs, especially the big one, the Space Force's RGXX program of record.
RGXX. So getting in on RPO now positions them for that much larger, longer-term opportunity.
Exactly. Winning pieces of RGXX could mean decades of stable, high-value government work.
Okay, so stepping back, we have this clear tension. The market is laser-focused on the Q2 miss, the GAAP losses, the execution risk, hence the stock drop. But management is pointing to the billion in cash, the $1.3 billion backlog, and all these operational milestones across Alpha, Lunar, Eclipse, and Electra. Plus the macro trends.
And those macro trends are supportive. Defense budgets, civil space budgets, they're generally favorable. You saw the Tactically Responsive Space Program get a $135 million bump for FY26. NASA's Eclipse initiative got a $250 million increase. The demand side looks pretty solid.
But it all comes back to execution, doesn't it?
Absolutely, 100%. The entire narrative, the credibility, it all hinges on getting Alpha Flight 7 off the ground successfully and soon, and then hitting the timelines for Eclipse and Blue Ghost 2.
If they do that, maybe Q2 becomes just a bump in the road from that April mishap.
Right. But if they slip again, that billion-dollar cushion starts to feel less comfortable. The clock starts ticking louder.
It's interesting how the analysts reacted too. Barron's called the quarter disappointing, focused on the volatility. But Cantor, for example, kept an overweight rating, $65 target, pointing to those demand tailwinds.
Classic divergence, short-term pain versus long-term potential, which brings us nicely to our next segment,
Where we talk about potential ideas based on all this.
Yeah.
And let me just say very clearly, this is not financial advice. We are not advisors. This is purely for entertainment, for generating ideas based on what we've discussed. Always do your own homework.
Definitely. Okay, so the stock got hammered because of the delay from the April mishap, right? But we know Alpha is now cleared for flight. Flight 7 is expected in the coming weeks.
Okay.
So you have a situation where the market punished the past problem. The next catalyst is imminent. And there's likely significant short interest, high volatility already priced in.
So what's the outrageous but plausible idea here?
Look, it's high risk, make no mistake. But consider short-dated, out-of-the-money call options specifically tied to the success of Alpha Flight 7.
Ah, a binary bet on the launch itself.
Exactly. It's purely betting on execution. If that launch goes smoothly, gets announced promptly, and maybe they quickly follow up with a date for Flight 8, you could see a very rapid relief rally.
A snapback.
Potentially, yeah. A relief rally, maybe fueled by short covering, that could significantly outperform the already high implied volatility in those options. You're betting the technical team delivers, and the market breathes a sigh of relief.
High stakes, betting on the engineers and the launch window. Okay.
It's certainly playing the catalyst.
So let's wrap this up. The key takeaway for you, listening, seems clear. Firefly's story is this tug of war. On one side, heavy investment, $1 billion in cash, a $1.3 billion backlog heavily weighted to government contracts.
And strong underlying tech, like their carbon composites, shared engine designs, the lunar stuff.
But on the other side, the brutal reality. It's capital intensive, it's technically risky, revenue is lumpy, and execution stumbles like Q2 get punished severely.
They need to bridge that gap between promise and consistent performance now.
Which leads to our final provocative thought for you to chew on. They have that $1 billion in cash. Management mentioned M&A interest, if it fits strategically, brings tech synergy. So what kind of targets might they be looking at? Could they buy, say, a specialized satellite component maker? Or maybe an advanced materials company? Something to accelerate their path, especially for competing against the giants for programs like RGXX or NSL Lane 1.
Yeah. Could they buy technology or maybe even engineering talent to speed things up? M&A could be a way to inject some speed into that roadmap. Something to watch.
Definitely something to think about. We encourage you to keep digging with your own research. Thanks for joining us on this deep dive.
We'll catch you on the next one.